I'm Deborah with Elevation Wealth Partners, and this is the market update for May. I'm talking today with Max Barnett. He's with Janus Henderson and is a regional director of sales. He's been with Janus since 2023, but been in the industry for 10 years. And part of his credentials, he is a certified financial planner, so we can relate to that. Welcome, Max.
Thanks, Deborah. It's really great to be here. I appreciate you having me on.
Yeah, well, the year has been really interesting so far in the markets. I have to say that our investors convey more of a sense of being confused and less confident in the stock market than they have in a long time.
Yeah, that's definitely understandable. I mean, it kind of feels like we've had probably 2, 3, maybe even 4 years already in just the first, 5 months of 2025, right? So I think a lot of people are confused. If we take a step back and just think about everything that has happened in 2025, let's first just kind of think about, let's get the bad out of the way, right? And so we think about it, a lot of the things that have been driving the market especially in the last 6 or 8 weeks or so, have all been around tariffs and the volatility that they've caused in the market, right? So we saw about a 19.5% dip in the market from starting on February 19th through the beginning of April. And this was all tied with tariffs and the Liberation Day announcement. It caused a lot of volatility in the market, and it certainly wasn't fun, but we've obviously seen a lot of things happen since then as well.
19.5% sounds really scary, but that's not unusual, right?
No, it's not anything that's crazy by any stretch of the imagination. So if you look at historically speaking, on a given year, the average market sell-off. So if you took the biggest time where we went from the peak to the trough, the average given year, we see a 10% sell-off. So 19.5 is more than average, but it's not, again, a crazy event, right? 10% is the average. So there's a lot of times where it's above 10%. Also, to put that into perspective, a 20% sell-off is what is officially considered a bear market. So we didn't technically hit a bear market, but one interesting thing is that we've seen a 19.5% or between a 19 and 20% dip in the market 6 different times, where it's dropped more than 19, but not quite hit that bear market target yet. So I think that kind of shows that there is some buying support from investors out there that helps us not breach that 20%. That's not to say that it never happens and that we can't see it at some point happen. It's certainly, we have seen bear markets in the history of this country, right? But I just think that's something that's interesting, that's worth pointing out. But what's more important to consider is that when we see down markets, it's a very good time to buy typically. So for instance, if you look at times when the market was down 15% and you bought the day that it was down 15%, whether it was a time like the Great Financial Crisis where it went down another 35% from there, or a time where we didn't even hit a bear market. If you consider all of those times, if you bought the day the market hit down 15%, you were positive 3 years later, 93% of the time, and your average gain over that period was 38%. So we never know exactly what the stock market is going to do. All we can do is make smart investing decisions. And history tells us that buying when the market is down, 10, 15, 20% is a really good investing decision if you're looking to hold for the long term.
Yeah, even though it's scary, buying when the markets are low, that's what has always held and what we always continue to say. So I know that Janus is always looking at the fundamentals of our economy because that underpins everything that's happening with the markets. So tell us, how are the fundamentals doing?
Yeah, absolutely. So the bottom line is that the fundamentals of the economy still look really strong. And that may surprise some people, especially when we saw what happened with all the volatility in the stock market in April. What is really important to keep in mind is that the market is always forward-looking and trying to anticipate what is potentially going to happen. And the reason why the market sold off was that fears about tariffs would cause weakness in the economy. But to be very, very clear, that hasn't happened yet. If you look at the economy overall, we are still seeing very low unemployment. Corporate earnings are very, very strong. GDP growth is strong. And also, very importantly, inflation is low. We're finally seeing inflation down in that 2 to 3% range. Now, it's possible that obviously could change at some point, but I think it's really important to understand that the volatility that we've seen is not due to weakness in the economy. It's fears that potentially things could happen to weaken the economy, but those fears have not come to fruition yet and could very possibly not ever.
Yeah, it's that emotional component to the markets there. So you've mentioned tariffs a couple of times already, and that's the biggest thing in the news right now. So can you just tell us and clarify exactly what a tariff is and talk a bit more about that?
Yeah, absolutely. Tariffs are pretty simple. A tariff is just going to be a tax on an imported good. What I think is really important to understand, though, is kind of the mechanics of how a tariff works, because there's a lot of talk about who pays for the tariff, and it's not exactly a black and white thing. But in terms of just who is the one that actually physically cuts the check for the tariff, it's actually going to be the importer. So how a tariff works is, let's say that I'm a company here domestically, right? Let's say I'm a construction company, and I need to import some sort of building material. Let's say some copper from China, right? And I need that for the houses that I build. Well, when I pay for the copper, then when we import it, the government is going to tax a certain rate on the purchase price of that copper. And I'm going to be the one that actually then pays the check for that. Now that the amount is going to depend on how much I paid for the copper, where the copper is coming from, right? Different countries have different tariff rates, as I'm sure you've heard, but that's essentially the mechanics behind how it works. Now, if you're asking of who actually pays for it, I'm the one that's cutting the check, but who actually is the one that's going to be impacted by the cost, that's kind of up in the air, and it depends on the various industries, right? Because let's say, for instance, that let's say there's a 10% tariff on China, and I can get copper for $100 here in China, but it's $105 here domestically. Well, if it's a 10% rate on copper, I'm going to have to spend $110 now if I import it from China, right? So now it's going to be cheaper to get it here domestically. So China might have to reduce their prices a little bit in order to get me to still buy from them, right? Because just like I wasn't going to pay 105 for the copper here domestically when I could get it for 100 in China. Well, now I'm not going to pay 110 in China when I can get it for 105 here, right? So the way that the various suppliers and buyers might have to adjust the prices that they pay with each other is a way that one country might have to pay for one good, or another country might have to pay for the tariffs on it over the other. That's if you've heard about people in the media talk about pricing power, that's what they're essentially talking about. Is some industries and some products, the supplier will have the ability to hold pat, and the buyer's just going to have to pay the tariff regardless. Other industries where they have less pricing power, they're going to have to adjust it more. So it's kind of murky. It's very complicated, but that's how a tariff works. That's the mechanics behind it. And that is what is being talked about a lot in the last couple months.
And of course, there have always been tariffs, right?
Absolutely.
Historically.
Absolutely. Yeah. So if you look at historically, there are always I mean, not always, but generally speaking, there are tariffs on most imported goods. The reason why this caused such a shock is because of how dramatically the tariffs increased. The tariffs that were proposed on April 2nd, those were literally the highest tariffs we have ever seen collectively across all the countries and trading partners that we were looking at. So it wasn't as simple as just, hey, now we're going to have tariffs. It was we used to impose, for instance, a 30% tariff on Chinese goods. Now we're suggesting we're going to do a 120% tariff, right? So you quadruple the tariff on our largest trading partner, that's going to cause some ripples. So tariffs have always been a thing. They're very important for helping out balance trade. It's just a question of how big of tariffs do you want to have? How much of a drawback will that happen? Will that cause, right? Because you're not essentially having a free market when that's the case. And that, of course, is the shade of gray that we'd love to deal with when it comes to the economy and American politics.
Yeah, well said. So looking forward, though, that's the job of Janus in helping to pick investments for your mutual funds and our investors. Investors really see all this as being very chaotic. And, they'll ask me like, well, do the rules still apply? Did everything just kind of blow up here? So how does a firm like Janus, look forward and do its work?
Yeah, absolutely. Well, bottom line is the rules almost always still apply. The rules that have been long held investing rules are long held investing rules for a reason, right? Because they hold up through time. A common phrase in investing is the most dangerous phrase is, well, this time it's different, because people say that all the time and it almost never ends up being different over the long term. If we're sitting here looking forward to what is going to really drive the market, though, it's two big things, and they're both policy related. So we've talked already about tariffs, and that's going to continue to be a big thing. If tariffs continue to get rolled back, like we've seen over the last month or so, we should continue to see the stock market do well, although probably with some volatility. But overall, the trend line being up. And then the other big thing that we're looking at as well is our interest rates. Interest rates are very, very important to the economy. There's a lot of confusion, or I guess disagreement, I would say, about how many rate cuts or hikes we're going to see in 2025 and 2026. So that is something that we definitely have our eyes on as well when we're looking at evaluating our investment portfolios.
Mm-hmm. Yeah, and that brings us very nicely to talk about the Federal Reserve. They haven't popped up in conversation yet. In the news, there was talk of possibly firing Jerome Powell, the head of the Fed. Talk to us about that.
Yeah. I mean, I think a lot of cool water has been thrown on that over the last couple weeks. So that was a big topic. First and foremost, it's not 100% clear that the president has the ability to fire the Fed chair. We think if push came to shove, he probably could, but we think it's extremely unlikely that that happens. In the event that that happens, we would expect to see a lot of craziness in the stock market and the bond market. And what this administration showed in early April is that that is not something that they want to be dealing with, right? They very quickly rolled back their tariffs, or maybe not roll back, but announced the pause on the tariffs to at least give them more time to see how they could execute it when the markets started to become crazy. It's been very important in our country to have independence between the Fed and the White House or other, elected government officials, because low interest rates are almost always a good thing for the economy and stock market in the very short term, but they're not always a good thing in the medium to long term. And when you're a politician, the short term is generally what is most important to you because you're trying to get reelected, right? But if we look at what the Fed, what is likely from the Fed is they're cautious right now. They're tracking inflation reports, and while I did mention that inflation has got down to that 2 to 3% range, the bottom line is that they're really nervous that inflation is going to increase if tariffs do increase and get rolled out. So the biggest thing that they want to do is avoid stagflation. Now, what is stagflation? Stagflation is called stagflation because it's a combination of stagnant and inflation. So typically we see inflation when economies are growing because people have more money, they have more money to spend, and it is okay to have inflation in that situation. The really, really bad worst case scenario for almost any economy is stagflation, where the economy is stagnant or shrinking while inflation is also growing. This is something that we saw in the late 70s. It it's essentially the boogeyman of any type of developed economy. And the Fed is really focused on preventing that from happening. So when we see inflation go up, if we also see the economy slow down, Fed's going to be really scared about that. That's why they want to keep interest rates relatively high right now, because if the economy slows down, then they can drop interest rates to get the economy going, or they can also hold them up, because the higher interest rates are, the more of a negative impact that has on inflation. It keeps inflation from getting out of control and can even push inflation down. So right now, the Fed is just focused on keeping interest rates at a moderate to highish level compared to the last 10 years, so that they can make sure inflation is dead and buried. And once that they feel comfortable with that, that's when they'll start to think about bringing rates down so that the economy can continue to have more growth.
Great. And in your opinion, what's the most likely scenario for our economy moving forward?
Yeah, so our belief is, let's start with tariffs first and foremost. Our belief is that tariffs are going to be rolled back. So we've already seen this a lot. We've seen some agreements be made with some countries out there, or large pauses, right? Whether it's China, the UK, there has certainly been some progress made on the tariff negotiation front. The bottom line is that the Trump administration did blink and get nervous after they saw the effect that the planned tariffs were going to have on both the stock and bond market. And our belief is that they are looking for any way to basically back off of this while also being able to claim victory, right? So most likely situation, they strike deals with countries, and then they come out and say, well, we played 4D chess by announcing these aggressive tariffs, and it was a negotiating tactic, and we got what we want out of it after all. If that does happen, and again, this is what we think is the most likely situation to happen, then you'll probably see pockets of volatility here and there in the stock market, especially in times right before a agreement is made, and we're coming up on the deadline before tariffs come back into place. You'll see some volatility here and there, but overall, again, we think the trend of the stock market will be positive. It will be up. If that also happens, we think the Fed will start cutting rates towards the end of this year. We'll get probably 1 or 2 rate cuts. Then at the end, then into 2026, they'll cut rates a handful of times as well. We'll see interest rates come down, and that will be good for the economy. We won't see rates get down to the level that they were post-COVID, when rates were literally zero. So if you're like me and bought a house last year, you're probably not going to get a 2.5% mortgage anytime soon, unfortunately, which I am very upset about. But overall, we will see lower rates most likely going forward. So that is what we think is going to be the base case scenario. The risky situation is if the tariff conversation doesn't get rolled back, right? And we do see escalation, and therefore we see a situation where the economy contracts a little bit. We might see some inflation in that situation from tariffs. And then we would also see the Fed potentially having to increase rates, which would have a negative impact both on the stock market and the bond market. We don't think it would be a situation that would be like a 2008 by any stretch of the imagination, but it would be a challenging situation if that was the case. We would expect both the stock and bond market, to lose a little bit of value in that situation. Again, to be abundantly clear, we think it's much more likely that the first situation happens than the second.
Yeah. So then, where is Janus seeing some opportunities to invest amongst all this?
Yeah, so we think that right now, the best opportunity to look at is going to be companies that are just high quality companies, right? So companies with strong balance sheets, good earnings, strong market share, profitability, right? The last probably 3 or 4 years, it's been the opposite types of companies that have really driven the market. The best performing companies, contrary to what you would think, have actually been the ones with kind of the shakiest fundamentals, because there's been this excitement over AI and other technological innovations that people think are going to drive the market. And when things are going really, really well, you don't need to be profitable, right? Because a rising tide lifts all boats. However, when things are getting a little bit more choppy, right? Like I said, even if the market does well this year, we do think it will be a little bit more volatile. That's when the companies with less great fundamentals will struggle a little bit more, and the companies with higher quality balance sheets will do well. So we think diversification is extremely important. The investments that have done really well for you over the last 2 to 4 years are probably not going to be the ones that do the best for you over the next 12 to 24 months. That does not mean to get rid of them in your portfolio out of your portfolios, because at some point we think, the economy will go back to favor some of those, lower quality, for lack of a better term, companies. But we probably are going to see a little bit of a paradigm shift in the market, and these companies that, are a little bit more healthy business models are going to be the ones that do better.
Which long term you would certainly hope that happens, right? When companies build their business in the right way and keep
Absolutely.
solidly growing.
Yeah. We want there to be an incentive for companies that are actually building good products or services, as opposed to be essentially a financially engineered entity that is just trying to capture some short-term, price growth. That's not healthy for an economy. An economy is healthy when you have, your Walmarts and your GEs and your Exxon Mobils that are providing good, tangible services to our everyday lives. And those types of companies are what we think are gonna do well in the near-term future.
Yeah. So any last thoughts here?
Yeah, I kind of spoke on it a little bit on the diversification. But it's really important to stick to your plan, right? When it comes to investing, concentration always beats diversification if you know where to be concentrated. And that's the challenging thing, right? And so when you have a shifting market, it's really hard to know where the winners are going to be. And that's why diversification is so important. And concentrated positions are things that leave investors more and more exposed to risk, right? Your financial plan is all about maximizing the probability of you achieving your financial goals. And that's what a diversified portfolio allows you to do, right? If you have a concentrated position, sure, it could be up 20%, but it also could be down a lot. A diversified portfolio is going to give you consistent growth over the long term, right? And if you, let's say you had two strategies, one of which is either going to give you a 30% growth or a 10% loss, and then another one is going to give you pretty consistently 10%, well, your total return, your expected return might be actually larger in the more risky strategy. But if you only need 10% to get to your financial goals, why would you take the risk, right? You don't need that extra growth. So that's the whole idea of diversification. That's the whole idea of a financial plan. And that's why it makes so much sense to work with someone like Deborah, because she's going to make sure that you're on pace to achieve those goals and do so in as little of risk as possible.
Well, that's the perfect point to end on. And thank you for your time today, Max. I really appreciate talking with you. Our next market update will be in July, and we'll see you then.